Well, guess what? Somebody that just kind of sold off their secondary, they've got an empty bucket. So it's constantly rotating through a cycle of lenders who are competitive, extremely efficient, and looking for the business. And only a mortgage broker is going to be able to assess that in that moment in time, whether you're buying today or you're looking tomorrow.
Welcome back to Passive Income Pilots, everyone. I'm your host, Tait Duryea. I'm here with Ryan Gibson. How you doing, Ryan?
Tait, always good to see you, and always good to talk debt, because that is what it's all about right now. Hard to get debt. That's expensive, and I'm looking forward to the show.
I have been looking forward to talking to David for months. Really, before we even launched the show, this was on my radar. We're going to talk mostly about residential today. David Temko serves as the president and CEO of C2 Financial, which is America's largest mortgage broker platform, currently operating in 30 states and employing approximately 1,000 loan originators. He's got a background in the mortgage industry. They do all types of loans. And we're actually going to have him back on in a future episode to talk about the differences between primary residence, second home, commercial, investment, all that sort of stuff. But for today, we talked a lot about interest rates and the home buying process. I think people will get a ton out of it.
Yeah, the framing here, I think, is like, do I buy a house right now with interest rates just going up 0.25%, but the Fed at the Fed funds rate at 5.5%? Doesn't make sense. Should I wait? Should I hang out on the sidelines? And who do I call? Who is the expert that I call to get a residential mortgage or a commercial mortgage from? And that's why we brought David onto the show to answer all these questions. And with that, let's get right into it.
Let's go. David, thank you so much for coming on the show. We appreciate having you.
Absolutely. Great to be here, Tait.
What a time to be talking about mortgage rates and home buying and everything. Really excited to have you on as well, David. I guess we'll kick us off and just say, what the heck's going on out there today? I mean, mortgage rates are up. Home sales seem to be slowing. I don't know. Maybe they're staying the same. Maybe there's just less inventory. What are you seeing?
Oh, well, great question, Ryan. My toast to the last holiday party is rates are up, but we can still get down. So, I mean, we're out here doing what we can, find an opportunity in every market. And that's really what it comes down to. There's definitely less inventory. Folks are sitting on their homes because it's an asset to have, an interest rate or a mortgage with an interest rate at 1%, 2%, 3% in the front of it. So unless something really happens in their life, death, divorce, dissolution, or something disruptive, they're really looking hard in the mirror, depending on, to determine whether they're going to move somewhere or not. And they're probably going to stay put for quite some time. And if they want to stay there and there's things that need to be changed, they're going to use some equity in their home and renovate it and stay there until, like I said, something changes and they need to move.
Do you see more sales in new construction homes or existing? What are you seeing there?
Well, I saw the CEO of, was it Lennar or Toll Brothers come on?
I saw that, yeah.
Yeah, they're trying to catch up for 15 years of underdevelopment and underbuilding. I'm based out of San Diego. It's a pretty established market, like most cities across the West Coast or, other metropolitan areas. And that's just a lot of infill. So I think that the new development is going to be in more affordable markets where there's more land. But generally, the larger metropolitan markets are going to be much more infill. So it's really, pulling together plots of land, lots, and then doing a subdivision. So I see that, but I think generally the majority of the sales are existing homes.
Interesting. Well, before we get into, all of this stuff, let's talk quickly about your background. How'd you get into the mortgage industry? And can you give us some history on maybe the industry and then as a little more specifics on C2?
Yeah, absolutely. I grew up in the business. My pops was an entrepreneur and got into commercial real estate, did commercial real estate leasing for quite some time, and eventually got out of that and found his way, did some appraisal business, but got into residential mortgage and was kind of an Excel guru and took what was kind of an archaic way of taking a loan application, on carbon copy paper and transitioned into that, doing that in Excel, and then hit the road and really sold that platform, brought people onto his brokerage at a high split margin and gave away that technology. And that was the genesis of a high split mortgage brokerage shop, and grew that, all the way through, through the years of when I was young in college, coming home, interning for top producers. So it was really always around the dinner table, the language. I was kind of shown some of the ropes by top producers that, worked at our company and, visited them. So, kind of got the origination side, kind of got the compliance side. And I graduated college in 2007, which was an interesting market to come into. And I'll never forget going out with my dad and his buddies. It was the Tuesday night out crew. They're all, successful guys, whether it was real estate, investing or finance or doctors, attorneys, whatever it was. They were kind of my board of directors. And I'll never forget kind of seeing my pops kind of almost pulling his hair out because the market had imploded. And his best friend, a guy I grew up with, hunting and fishing with, that I looked up to greatly, was a big commercial real estate investor. And he was just kind of steady Eddie, cool as a cucumber. Hey, I'll have another beer. And I recognized in that moment that that was an opportunity for me to go into that. And I left the family business of being in, residential mortgage brokerage. And I signed up in commercial brokerage, doing sales, and cut my teeth, real boiler room type situation. And just making, 60 to 120 calls a day, and trying to, cut my teeth on that. And it evolved into me actually getting into the capital markets side, doing commercial loan brokerage. And I really felt that that was a really good happy medium, that axis of having the residential mortgage background, wanting to be on the investment side and learning that acumen on the commercial side, and doing commercial loan brokerage was just a perfect fit for me. Granted, I was making, 25 basis points straight commission. So right. Fortunately, my overhead was super low, so all I needed was some beer money in those times, and but it was good. And that's kind of how I got into commercial loan brokerage. Eventually, got recruited out, did commercial banking, but my involvement in our family's company drove me back to them and to the organization, and building a commercial mortgage brokerage platform at C2 Financial was a really good opportunity, because it allowed our, the breadth of our business has always been residential mortgage brokerage, but the decision people make when buying a home is often one of the largest they're ever going to make. And the loan officers that we have that steward that experience of that capital can be so much more for their clients. They really are a full financial and real estate resource. And so oftentimes when a borrower gets a loan from a mortgage broker at C2 and they do a great job, they come back and they say, hey, you knocked another park on my home loan, getting me in there. I want to buy an investment property, a commercial building, or, whether it's for an investment because it generates income, or they have a business and they want to buy a property for their business. And in the past, that individual would say, hey, I'm sorry, I can help you with that. And then it kind of gets out of their, I don't know if it's their sphere of influence or, but that person finds a yes person and then they're out. And so my goal at C2 is really to, in the C2 orbit, have our loan officers, truly be that financial and real estate resource, whether it's forward mortgage, whether it's reverse mortgage, whether it's commercial mortgage, or there's a sales component. And that's really what I drive to do, to grow the company and, attract talent all over that can do that.
That's great. And, you mentioned like attracting talent and kind of building a business. Contrast that to, kind of your first few mortgages that you did maybe on your own, to how you've really scaled. I'm always interested in that side of things, because as a real estate investor, I was always like really focused on the real estate investing. And then we grew to over 130 employees. And now it's like, there's a lot of leadership that goes into kind of handling that. Kind of talk about your team and sort of what's your day-to-day like today?
Yeah. I mean, the first loan to your first part of that question, the first loans that I've done, it's like, what you know, and you kind of don't know a lot. So you're kind of taking all your experience and looking to expand on that through each transaction, through each opportunity. You always learn stuff from. And that's why you kind of lean on, specialists that have that experience that you don't. So, I mean, sure, the first couple loans I did when I was, in brokerage or in banking were were rough for me. We're probably rough for the client, but keep your head down and you power through and you continue to deliver a good experience. And for us, there's a lot of folks out there that, have come from different places and how they land at C2. And it's about finding folks that are really good at what they're the best at. And a lot of times people are really good at doing loans or really good at finding investment properties, but there's a lot of things that surround that they're not good at, that they don't want to do. And so at C2, we basically take all the stuff that they don't want to do off their plate. And that's legal, licensing, compliance. So we have a platform where loan officers can really just focus on what they're the best at, which is finding borrowers and making sure and placing them with the best financing that's the most conducive for whatever their financial need is, depending on what the property is they're buying and their kind of, nuances with their own finances that generate income. So, but yeah, that just takes time.
Yeah. Well, I certainly can plug you guys because I, came across you by using one of your officers who was fantastic. And I got a really great refinance on my place. But I'd like to switch gears to, the industry, to interest rates. A lot of people, I hear this on a weekly basis that I'm waiting for the crash. I'm waiting for prices to come down. What are your thoughts on that? What are your thoughts on interest rates, where interest rates are going? Sort of where are we in terms of the market? Because you probably have your finger on the pulse just as well as anyone.
Yeah. If you're waiting, so is everybody else. So,
Right.
It's like, oh, everybody's, when rates come down, I'm going to be in the market. Well, you and everybody else that's, sitting on the sidelines. And I think if you have the ability or you have the affordability to buy, or the acumen and the ability to buy a property now, you're going to be in a better position than somebody that's waiting for rates to come down. Because when rates come down, you can refinance and you're in a better, you're in a great spot because you bought it while, rates were high, maybe values were either relatively stable or have come down, versus when rates come back down and then, prices spike again because there's a huge demand back in the market. So I think if you're sitting on the sidelines and you're paying rent, well, I think you should do kind of a cost analysis on what you can, write off in terms of the interest, compared to for the entire monthly payment. There's some tax benefits. And so you can reverse engineer, okay, I'm paying this much in rent, but it's just to sleep and eat here. And I'm not building any equity, versus what I can buy. And maybe there's a premium to that, but I can, there could be upside in terms of, appreciation. I can, write off my interest. So there's a lot of benefits and pride of ownership. So, and plus where you want to, set some roots down. I mean, where people are at in their life. It might not mean they need a house and because they're living in an apartment. Maybe it's an opportunity to buy a 2-unit, a 3-unit, a 4-unit, get, residential financing. And that's an opportunity to get in your first investment property. It doesn't change your life, your lifestyle that much. It doesn't increase from a cost perspective, from a space perspective. So it's really assessing what you need, what you're comfortable with, and seeing what calculated risks you can take that fit into your life in that moment.
Right.
And what do you have like a tool that people use or a website that would go and kind of help analyze those types of decision making on, rent versus buy? How much am I spending? Do you have any like online calculators or do you just use kind of just like general amortization calculators or things like that?
To be honest, I do have something that I've created on the commercial side that was really for an owner user that's renting a space. My corporate office is 7,500 square feet here in San Diego, and I ran that exercise because my lease is rolling in October, and I was like,
there you go.
So I kind of went through that rigmarole, and I can see kind of what my rent is, what my down, relative to a down payment and what my monthly payment is and how that shakes out, you can make any spreadsheet look amazing, but I try to be relatively conservative with appreciation, and maybe put like 1% versus like a 3%, 1% appreciation over the course of a year. And it'll tell you, how much wealth you're going to build, how much equity you're going to gain over that. And so I have something like that and we use that on the commercial division that I have a gentleman running for me and for our company. On the residential side, that would be something I'd lean on. One of the 1,000 amazing loan officers that we have that focus on that. They're going to probably have the acumen to help someone like that. And if somebody's looking at C2, there's the loan officers that are with us are the best in the business. They've been around for the longest. They're seasoned veterans, and they can definitely help guide that process in terms of helping a potential buyer understand the benefits of homeownership compared to where they're currently at renting.
I got a question for you. So, one of the terms that I've heard thrown around, which I actually really agree with, is you marry the property and you date the rate, right? It's like, you can always refinance if interest rates come down and you lock in the price today, because as you alluded to, this is not 2008. People have a ton of equity in their homes. There's the rate lock effect where there's restricted inventory because there's so many mortgages sub 4%, 3% interest, and so nobody wants to sell. And there's also a supply shortage, which was the complete opposite in 2008. So I'm with you in that we're at a completely different time in history right now. So if someone wants to buy today and refinance later, can you sort of walk through a description of that process for someone who's never done a refinance before, maybe some risks and what that process looks like?
Yeah, absolutely. And it's interesting to me how ingrained it is in people's minds to get a 30-year fixed. And if you look back historically, if you look at a chart, a 7-year fixed or 7-year ARM is always going to win in the long term. And generally people's lives change, and they're not going to be, I just don't know that many people that have actually got one loan fixed for 30 years and 30 years later they paid off and that was the only loan they've ever had. It's right. Unheard of. So that's a situation, unlike a husband or a wife that you're married to and you have a 30-year anniversary. I mean, that's a totally different program. There's probably a lot more happy marriages out here than 30 mortgages that actually went to the finish line.
Yeah.
But I think, like you said, if you love the house, then get, the rate and the terms that fit the, your strategy in that moment. I think that we're all kind of, optimistically thinking that rates are going to come down sometime middle of next year. With the way the Fed is operating, they really only have one dial, which is raising, the Fed funds rate. And we're probably anticipating another 2 pops on that, just because they're, that's their job and that's what they're trying to do. And that's their plan.
We'll find out tomorrow.
Yeah, exactly. A lot of data going into that. But if you like the home and it fits your lifestyle, then get into it, whether it's a 5 or a 7-year or a 10-year. The 10-year treasuries, the 10-year fix actually trade. There's a larger market for that. So generally the 10-year fix is going to command a lower rate than a 5 or a 7 would, which is interesting. I just recently bought a house and I did a 10-year fixed, and I'm going to, get in there, fix it up, live in it, make it comfortable for me where I'm at in my life. And then when rates come down, I will be in the market to refinance. So I'm dating that rate.
There we go.
The big theme is refinancing, right? Like buy the house, date the rate, marry the house, etc. What risks do we have in that? And, what kind of processes would you be following, or what are your thoughts on, sort of the so what there in the future?
Great question. I mean, the risk is that rates just keep going up, and I just don't see that being the case. I think a healthy market is rates in the 4s and the 5s. I think that's a real healthy market. I think, we're just trying to recover from the historically low interest rates are probably out there for too long. Rates in the 2s and the 3s are just the low. I don't think we'll see that for ever or very, very, very long time, unless something extremely catastrophic happens and they have to do it to spur the market all over again. I think we're kind of seeing this rise. We're going to get another 2 pops. Unfortunately, it's sad to think that they have to, really knock down the job market in order for inflation to come down. I don't agree with that. I think it's really a productivity factor. I think it's really getting people to work and working hard and using the money in the market through trade. through that production versus raising interest rates and knocking jobs down, and people going, oh shit, I don't have a job, I got to focus on my savings and spend a lot less for inflation to come down. I don't really like that approach, but like I said, that's really the only approach that the Fed has, and that's what they're going to do.
Yeah, I agree with you there. I think that it's the Fed only has one tool. All they can do is throw cold water on demand. They can't spur productivity. That has to come from Congress, basically, and then it takes time.
Right.
So,
the other thing that I think is interesting, so I bought my first house in 2009. Great time to buy, September 2009, right at the bottom. And I think my first interest rate was 5.5, and then I didn't know anything about refinancing or what it was, or I was really ignorant to the whole process. And rates dropped to 4.5, and then I was like, oh man, I should probably refinance, right? Does that make sense? And then they dropped again, and I think I ended up refinancing my house 4 times or something in the course of 5 years. Is there any rule of thumb that you have, how much should interest rates drop, or what is your thought process there? What are people waiting for to spring into action on a refi?
Well, there is costs associated to refinancing. I mean, there's definitely some thirds. You have title escrow appraisal. So there is costs associated to it. So, but if you look at that compared to where your rate was and where you're dropping your rate to and your monthly payment to, you can quickly assess how quickly you're going to capture the cost of refinancing it. So, I mean, you refinancing that many times over the course of 5 years, it makes sense. If you did it that many times in 1 year, then I don't think it's going to make sense, and you're going to kind of irritate a loan officer because there's some components of that really could have some repercussion. But I
don't know how many times it actually was, but it felt a lot. Like at one point my wife was like, does this even make sense? Because it costs money to do it every time, right? And I think I ended up going all the way down to 3%, right? And so or 3.125% or something like that. I was trying to figure out is it 1 full point? Is that kind of the heuristic, or is it a half point, or I don't know? Is that something is that a way to think about it, or something else?
I think a full point to drop is pretty significant. I think if it's, in between that 50 basis points to 100 basis points, that, half a point to a point, then you're probably right in the strike zone, and it's worth it. But like I said, you can look on a regular amortization calculator going, hey, this is what my loan amount, this is my monthly payment now. You can look at what your principal balance is in that moment, based on your most recent mortgage statement, and go, okay, well, you probably haven't paid down that much principal in the first 5 years, but maybe you have, maybe thrown a little bit more at it, or maybe something happened in your life where you have a larger liquidity event. You go, you know what, I want to work on paying this down. I've got $1 million loan. I want to knock it down to 900,000. Interest rates are lower. I want to do that. But then there's something to consider on that is, maybe I keep my interest rate or keep my loan at $1 million and drop my interest rate, and I use that $100,000 to go invest in, in some type, where I can get better arbitrage. My money's better spent. And that's where, you look to somebody like Tait and you as well, whether it's apartments or storage facilities and something like that. So a lot of stuff to consider there too.
Yeah. So I want to skip ahead to a question that I was going to get to, which is HELOCs and sort of accessing lazy equity in homes and rental properties through refinance. And one of the points I want to kind of make here is that you can go both ways. So you can either refinance and take money out by taking a larger loan, or you can put money in, you can come to the closing table, which is actually what happened with my last refinance. I came in with about $20,000 to bring it under the conforming rate, under the conforming limit, which allowed me to get about an additional 50 basis points off my rate. So anyway, but when we're talking about pulling money out, can you kind of talk to that in terms of what that lazy equity means if you have a bunch of equity sitting in your home that isn't really doing anything for you, and sort of using that to arbitrage?
Yeah, absolutely. I do think that there is opportunity to take advantage of HELOCs or standalone seconds. And that's really, first and foremost, it's a function of what other revolving debt people have. If they have, and that often from a loan officer standpoint can be easily addressed from a credit report. If somebody has outstanding revolving credit card debt, that's in there's a 2 handle in front of that. There's a 20+% interest rate on something like that. So consolidating that debt in something that's going to be, maybe 10+%, between 10 and 12% is generally where you see in seconds a lot of times, can be a huge reduction of cost in terms of interest being paid on that. So that's definitely a good utilization of financing to consolidate debt with equity you have. But to utilize the equity that they have, that lazy equity, I mean, there has been a lot of appreciation. It depends on how long someone's been in that home. If they've been in that home for quite some time and they want to utilize that equity and they have opportunities to put it to work, it just depends on where can they put it to work and like where that positive arbitrage is going to be, and or what's happening in their life. They got kids that are going to school. They got whatever it is. If they need to utilize that, I mean, there's no question about it. They can, and it can be a good source of capital. And it's just kind of, they've earned it, so they can definitely use it.
Yeah, hot tip on this conversation. We bought a bunch of self-storage over the last 5 or 6 years, and we got great first mortgages on the properties, low interest rates, 3 to 7.5 to 4.5, something like that. And part of the business plan was to eventually expand the property, so put on additional units. And what's really neat is that you can actually go back to the same lender that lent you the first mortgage, and they essentially look at your expansion plans, and instead of rewriting the entire mortgage and wiping out that really great first at 4.25% or 4%, they'll do a bolt-on loan that's separate. It's like a second position, kind of like a HELOC almost, where that interest rate is higher, but the blended interest rate on the two loans is still really attractive. So I know, Tait, you're in a few deals of ours like that where we've done that, where we've actually expanded the property and gone back to the same lender to get the construction expansion loan, because we didn't have our plans completely dialed in at the time of acquisition. That's why we wouldn't have just gotten it then. So we've dialed in construction budgets and everything much later because we got our permits done, and now we're approved to start construction. Now the bank is ready to release the funds, but now the interest rates are 2% higher. So we're getting that 6%, 6.5% second, but the blended rate is really good. So think about that in your home, right? Because you got that first position that's really, really low. And even if you get a HELOC that's higher, although it's going to be pretty high right now, that blended rate is still pretty attractive, especially in today's time. So, absolutely.
And Ryan, I got to say, the storage facility product, I love that product. The tenants, they just don't talk that. I mean, you don't have any problems with them, really. They don't even use the bathroom.
Why we love them.
There are no bathrooms sometimes.
Exactly. They just sit there. It's like.
Yeah.
They're sticky. Yeah. Fun fact: the average tenancy for a self-storage unit is longer than multifamily.
Is it really?
That's wild.
Okay. I love it. Yeah.
Huh. How did you not know that, Ryan?
Years ago, someone asked me that question, obviously, and I did a study, and I went online and pulled all this data, and it was inconclusive. I couldn't find, and so I just say it's all about the same. Our average portfolio stay for storage is about 28 months. I don't know what it is for multifamily, but I couldn't find an exact study.
The average is about 15 to 18 on multifamily.
Oh, is that what it is? Okay.
Yeah.
Yeah.
Anyway. All right. Next question. So why should someone work with a mortgage broker like C2 versus directly with a lender, with a bank? What are the differences in terms of experience, rates, and then how does somebody know that they're getting the best rate?
Great question. And I just had this conversation with Brandon Landau, who runs my commercial division earlier. And I have the conversation with loan officers at C2 all the time. And really, and this comes from my experience at being in banking and being on the broker side. And from a bank perspective, you're really hammering round pegs into square holes all day. You're kind of a one-trick pony. You have one credit box, and you're trying to figure out how to get all these different people to fit into one box. And it's just not one size fits all. And as you can, and what we experienced last spring with what happened with banks, the run on banks has left a lot of uncertainty in people's minds on how banks operate and how safe they are and whether they're in the business or out of the business and what they're lending on and what they're looking for. And from a commercial standpoint, they're definitely in and out, more on the outside. from an investment property standpoint. They're definitely after owner user stuff, which I've got a pretty good pulse on, and that's conventional or SBA or whatever that is. And then the residential side, I think, unfortunately, I banked at First Republic for all the reasons that I really like them. That personal touch, that fact that I run a business with them, and I get, I have a personal relationship and a business relationship with them. And when I buy a home, I want to use them. And I bought a home and they were gone, and that's crazy. And what did I do? I used a mortgage broker, and they have a much better pulse on who's in the market, who's out of the market. At C2, we have 100 plus lenders for our, call it 1,000 loan officers to utilize. And these lenders, these wholesale lenders are often either in the market and they have a bucket to fill and they're very competitive. And all of a sudden our loan officers can kind of, direct business to that bucket because they have borrowers or buyers that are in need. And that's the most competitive lending source in the market. All of a sudden that bucket gets filled. Well, guess what? Somebody that just kind of sold off their secondary, they've got an empty bucket. So it's constantly rotating through a cycle of lenders who are competitive, extremely efficient, and looking for the business. And only a mortgage broker is going to be able to assess that in that moment in time, whether you're buying today or you're looking tomorrow.
Interesting. Okay, so I want to make one quick point, and that is that if you have a loan with a bank that fails, it's not like you are going to have to pay it off. That loan to you is a liability. It's an asset to someone else, and it will get bought by someone else. And the interest rate that you have, the payments that you have, those things will just keep going. It's not like you're not going to have to pay your loan or not like you're going to have to pay it off, right? So I just wanted to make sure that was clear. That makes a lot of sense, right?
I'm a client of Chase Bank by default.
Right.
We all are.
There you go. Chase bought your note, and now you owe Chase.
The other thing I really want to point out, because I know that there's interest rate chasers and people trying to save every single nickel on a mortgage. When was going through all my little refinance, like tycoon or my cyclone of like refinance, I was a really easy borrower. I had 2 incomes. I was W-2, perfect credit score, really affordable house for what I was in, tons of equity built up in the home. I went on bankrate.com. I don't even know if that thing exists anymore. And it was like Priceline for finding the cheapest rate. It really didn't matter who I banked. I wasn't in a hurry. Like it just sort of didn't matter. Now my circumstances have changed despite the fact that I've amassed tons of assets and I have a lot of net worth. I also am very complicated now. Right. So work with the person who's going to best suit your needs. And, a mortgage broker can be highly lucrative in that. I only work with certain mortgage brokers now. I can't just go on Bankrate and look for the lowest rate. Like I have to go to somebody who understands who I am and that I have a gazillion tax returns and I own a business and all that stuff. So, match up kind of the complexity of who you are with the person that you're trying to hire, because that will really help, I think, the process a lot and save you a lot of stress. So.
Absolutely. Great point. And, working with, a mortgage broker that has the acumen, that has the, whether it's a personal understanding, a business understanding, but also has the resources, sure, you could be working with somebody that fully understands your credit, your credit profile, all your tax returns. But if they can't do something because they're at one shop, they call the golden handcuffs, then what can you do? You got to go to somebody that understands the nuances of your business and your financial profile, but has the ability to go execute with the best lender for you in that market. So completely agree.
Right. Yeah, this is, again, just having, building your team as you become more sophisticated as an investor and just building your financial acumen, you inevitably end up with a team around you. And this is just another person on that team. So you may have found someone who told you a story about how they got this amazing loan directly from a bank. But, David, as you alluded to, pounding round pegs into square holes, it's like that person just happened to meet exactly what those banks' criteria were, right?
Right.
Which is not going to be the same from one person to another, depending on your financial situation. So anyway, what's the difference between a pre-qualification and a pre-approval? If you're looking out for a home right now, which one do you want?
Well, a pre-approval is something that's a bit more fleshed out. You've provided financials to a loan officer. They've ran a full pull on credit, so you're pre-approved, and they can determine what you can buy, what you can afford. A pre-qual is kind of high level, and we have this conversation on our side of the fence all the time because our loan officers want to be able to issue a pre-approval because realtors and sellers are, they're teed up. They understand that this person is pre-approved versus pre-qualified. Something that's pre-approved is going to be much further down the line with a lending source, with a mortgage broker, with a bank versus somebody that's just pre-qualified. Oh yeah, I make this much. This is my credit score. Okay, you can qualify for something like that. Sure. They're just going to be a little bit further down the road. And in a competitive environment when, there's there's not a lot of inventory with a high demand, you want to have your best foot forward. And that's having a pre-qualification, but also working with a mortgage broker that has the ability to execute really quickly. I got a loan done in 12 days. I mean, we're going to have to change TRID because how quickly things are moving on the wholesale side. I mean, we're going to beat, we can close deals faster than regulations would even allow, where that's just definitely not the case with the bank. That's going to be a bit more archaic. They're like dinosaurs compared to where we are, how things operate on the wholesale side.
Yeah. That makes a lot of sense. What are some of the things that people need to remember during that process? So if you're shopping for a home, you got your pre-approval, what are some common mistakes that buyers make that might blow up their pre-approval or make their loan more complicated?
Well, it's, everybody wants a deal. I'm definitely a fan of getting a deal on everything.
Yeah.
I can have a tendency to grind a bit on all, just so and if I didn't ask, then I wouldn't know for sure. But I think there is a component, there is a certainty of close component that I think is important to address because sure, maybe you could have shaved off a few basis points if you went somewhere else, went to that bank that took 30, 60 days. But guess what? That rate, maybe you gave that rate, but you would lost that house. You know what I mean? So
Right.
It really comes down to having the ability to execute, obviously getting something very competitive in that trust. It's stressful. These are big decisions. This is something that, can get emotional, specifically a home, somebody that's maybe expecting a child and they're like, hey, we need to move out of our apartment. We need a house that has an extra room for a nursery. Because, there's a lot of different things that happen that can affect people's decision-making ability and how they're going to react. And you want to have that person that you trust, that can execute, that is going to get you a good deal. They're going to relieve some of those stress factors, which is contingency period, getting your financing contingency removed or whatever that is. If there's a way that you can kind of get out ahead of that stuff. So you're like, oh my gosh, our money is going to go hard if we don't, then in kind of circumventing all that, I think that's important because it is a big decision and there are stress related and there's sellers in that want to turn up the volume and really put people stick it to I've seen things happen where there's unnecessary stressors that can be put in place to make somebody really move when they're unsure and they could have been working with somebody that could have been on front of it. So that's what you get when you work with an expert, like that we talked about earlier. Like I might not have known that in my first couple of deals, but I've been in this business for a long time. We got people that have been at this business at our company for a long time. They know how you get that with that expertise.
Yeah. I like that.
I have a little off script question here.
Yeah, love it.
I've never, as simply as you possibly can describe it to me, the federal funds rate is the rate at which the banks borrow money, right? That's the overnight rate. That's the interest rate we hear about in the news. Like the Fed raised actually 28 minutes ago. I just got the alert. It went up a quarter point.
As expected.
Bummer. Anyway, that was totally expected. So it went up a quarter point. So this is a great example. So I think the federal funds rate right now is like 5.5. Is that what it is?
Mm-hmm.
Does anyone know?
Yeah, it's at 5.25.
5.25. Let's just say it's 5.5 now.
Mm-hmm.
How the heck does but if you go for a mortgage rate, right, it might be lower than that, might be higher than that, might depend on number of things. Like how can somebody how does that tie to the federal funds rate for home mortgages? Like if I was just going getting a regular primary resident Fannie Freddie backed loan, how would that rate be determined? Or how does the wizards that make the rates come out be determined?
Yeah, the gremlins on the other end of the curtain over on Wall Street.
Yeah.
That was already baked in. They already knew that was happening. I mean, the market has already assessed that there's going to be a raise in the Fed funds rate. It's already been baked into the market. You watch CNBC in the morning, they pretty much had already accounted for it. Generally, mortgages are based off the 10-year treasury. That's generally where things are. And then there's a spread over that. So it's usually borrowing at, a lot commercial mortgages, residential mortgages, they're going to look at that. And the 10-year treasury is going to be much lower than that Fed funds rate. That Fed funds rate is like a prime rate, which is often what's tied to how banks will lend on lines of credit. They'll do, okay, we're prime +1 or prime -1 ideally. So you see that. And so that is, obviously a factor, and that a lot of times banks and or lenders, specifically depository banks, they have an internal cost of funds. They have what it costs for them to have money on their balance sheet, whether they're paying, they haven't paid anything for a long period of time, but generally if they're paying interest for deposits, they have to factor that in. Plus they have to factor in the cost of putting a loan on the books. So they have an internal cost of funds. So it's usually like when I was in commercial banking, we would look at the 10-year treasury and we put on like 170 basis points. And that was the spread that the bank needed to make over the 10-year treasury, but they're not borrowing that money. In the event they did, that's how they would look at it. That would be their cost of capital if they didn't have a depository, they didn't have depository relationships.
So right now,
so that's kind of how it's.
Yeah. So right now I'm Googling the 10-year treasury. It says it's 3.861%, just changed.
Right.
In real time here. So you're going to put a 1.5% spread or addition to that rate to drive your kind of understanding of where mortgage rates would be. Is that right?
Right. There's a spread over that. So that's the cost. That's just the cost of capital for like a 10-year treasury, like a 10-year T-bill. So that's what a warehouse lender is going to pay. And then they're going to make a spread on that. So their cost of capital plus their spread, they package it up, they fund loans around that, where that market is that day, where rates have fluctuated in the market. And then they, whatever their credit box is, they package it up and they sell that on the secondary market. And that's bonded.
So can I use a car analogy here? So if I go to the dealership and I say, I don't want to pay $1 over dealer invoice, right? Dealer invoice is basically going to be the 10-year treasury plus 1.5%, which is 5.36%, just real quick math here. And then someone's got to make money. So when you talk about earlier in the show, you were saying, hey, there's a lot of, shops, mortgage houses that are just piles of cash and they need to get it out the door. So they're probably going to be selling that inventory for a lower spread over sort of like dealer invoice. Is that accurate or is that not?
It's a supply demand, right? If there's a huge demand, then that truck or whatever that car is going to have there's going to be a sticker over MSRP because, everybody, dudes want a Ford Raptor. They're going to pay, $15,000 over for it or whatever it is. Right.
And I'm sort of leading into imagine what's going to happen in a year when interest rates fall, if they fall, and everybody's been on the sidelines waiting for these prices to drop. And all of a sudden they drop. Everyone's going to come running in at the same time. And guess what's going to happen? They're going to run out of inventory, right? So those spreads can go really high. It's going to be a heyday for mortgage brokers, right? Because refis are going to be through the roof. We all saw this in COVID, right? When interest rates kept going down and down and down and down, and everybody just kept refining. It was a crazy time. It's a little light right now, so maybe now is the time to go out and good hunting, right? You can probably find something, and the interest rate. Check your balance sheet and make sure you can pay the higher interest rate. But maybe it's not such a bad idea to. Because anytime you have increasing demand, you have increasing prices, right? And so right now, there's not a huge demand for homes because everybody's sort of waiting. And if that demand accelerates with lowering of interest rates in the future, you could have a crazy frenzy and end up paying probably more potentially. Not that I'm a huge advocate of go buy a house right now. I'm just saying, give some thought into where the economics might go and where the indicators are. So anyway.
Absolutely. I mean, if you can afford to buy a home right now based on where interest rates are at and the price, of a home that is conducive for your lifestyle, then I would say go for it. And then you're going to be in a much better position when rates come down and everybody's in the market. you're going to be refinancing based on where you bought, today versus where you're going to have to buy with rates coming down and the demand being there, which drives the value up, or the prices up. So I think affordability is a huge driver, which is why you see a lot more people moving out of California into, decent size, metropolitan areas, places above 200,000 people. I'm not talking anything below that I think there's more risk, but anything above that, there's a lot of drivers through the Midwest to the East. I'm actually going through a move right now because I bought a place and it was surprisingly when I was picking up a U-Haul, they're like, "You're lucky you got this. We haven't been able to have U-Hauls at all. People take them and they drive them and they don't come back. Like everybody's taking them from California elsewhere and they're not here." And so that was like an interesting gauge that I picked up. I'm like, it was kind of a trippy kind of dial or metric or kind of whatever it is, data point to look at for people exodusing.
Yeah, you can actually look at U-Haul reports data of like where all the U-Hauls are going, and it's really interesting.
That's actually one of the metrics that we watch as a fund in order to sort of create a macroeconomic thesis on where to buy.
Yeah,
I think it's great. I think it's a great gauge to look at, like where people are taking these trucks and not coming back from.
Yeah.
Well, David, one question I'd love to ask our guests is, what's something in the past 6 months that just has absolutely blown your mind, changed your way of thinking, something you've learned that you really haven't shared with anybody, but it's been like, maybe it's a half-baked thought, maybe it's in the back of your mind and you're just like, you can't really put a pin on it, but it's like a feeling you might have or a new idea, just anything you're like, man, I can't believe this, or sorry, I'm rambling to give you some time to think about it.
Yeah, no, I think that we are very blessed to live in a country, in a society that has an incredible opportunity to work hard, to earn money, and to put it to work. And I think that regardless of market conditions, we are always going to be in a place that we're safe for the most part. We've got good neighbors to the north, good neighbors to the south. We've got a big body of water to the west and the east. And I think, real estate here in America is always going to have great value. I think it's where you want to live, what you're comfortable with, and I think that there's opportunity in every market. I think an interesting thing over the past 6 months was that recent bank run, considering where I banked and, the run on. And I think that social media has the ability to create widespread panic so easily, where it was, way different back in the day, when people had to pick up a newspaper to see something happen yesterday, or, or call or get, on a rotary dial phone to hear from somebody. And now it's like somebody can just post something and boom, it's like millions of people can see it. They go to a bank, they rip out all their deposits, and all of a sudden, we've got a situation. I did learn that it's really interesting to me how leveraged banks can be. For every, dollar they have, they can lend 10. I thought that was really interesting, that leverage that was, and so it's interesting. I think looking at a bank's balance sheet and seeing what bank operators are conservative is good to know. But I don't believe that having 5 main banks in our country is the best for our economy. That really the underlying fabric of our economy is small business. And those small businesses are helped operate by local banks, local credit unions. And you have to have faith in that. You have to have faith in those business bankers, in those personal bankers, because if we're stuck with 5, I think we're going to be in a world of hurt.
They have no interest in helping us. Yeah. I mean, I get laughed out of the room. I mean, I barely can open up a bank account efficiently with JP Morgan. I mean, it takes like 3 weeks or something, right? So I hear you. And, local banks are killing for us to open up deposit relationships. I love that last statement. I mean, that is definitely a concern. I have to ask though, you have a surfboard behind you. It looks like that's what it is.
Yeah.
With dollar taped to it. What's the story there?
The dollar's glassed in. Actually, it's a cool surfboard. It's a local shaper. I grew up surfing. My first class of the day was surf PE up in Encinitas, where I'm actually moving back to. So kind of getting back to my roots. But I've got a couple boards around my office. I think it's a good vibe. It suits kind of my personality and the overall culture of the company.
Cool.
It's amazing.
What do you guys have, like a mission, vision, values? What's your mission statement or your focus as a company?
I believe that every rooftop that a C2 loan officer touches, they're going to improve the lives underneath that roof. And the more places and people that we can help across the nation, I think the more value we can drive to communities and homeowners. I believe in that American dream, which is now kind of a universal dream, but I think pride of home ownership is a very powerful opportunity, and it allows people to go to sleep and rest their head and get up and add a lot of value to where they live and the community around them. And if we can help people achieve that, then that's really our mission.
That's incredible.
Tate, you want to take us home?
Yeah, so we're going to have you back on to talk about residential and second home and investment loans and things like that. But for now, we'll bring this thing home and let the audience know how they can get in touch with you or engage your services, because I'm sure there are a lot of people out there that are looking to buy homes, second homes, investment properties, all the above.
Yeah, absolutely. Well, it's amazing being on with you guys, and there's so much to cover. I loved all your questions, and I feel like we only got through half of them. But really,
Right, my fault.
C2, it's all good. It's all good. Yeah, so our website is www.c2financial.com. And on that, you'll be able to find, our platform for forward mortgages, reverse mortgages, commercial mortgages, and we do some sales in California. We have division leaders and really, savvy individuals that work at our firm that can help. And I am always available. You'll see my, contact information on there. It can be found on LinkedIn, social media. My Instagram is really just kind of my personal life connected with my business. They're kind of one and the same. How I live is a derivative of how I run our business. And that's really our culture here. So our people are cool. They're approachable. They're extremely savvy. And if you're in the market to buy a home or investment property, I'd highly suggest using an expert at C2.
Well, I can vouch for that. We'll link to that in the show notes. Thanks so much for joining us, David. We'll talk to you soon.
David.
Absolutely. Thank you, Tate. Thank you, Ryan.
Take care.